Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. We're going to rip through Twitter, see what people are talking about. I'll be reading their opinions, giving my opinions on what the market is all about. It's going to be wealth related, commodity related, or financial topics. That's generally what I talk about. That's what I like talking about. And hopefully all of this works out for anyone who's listening. I'm playing the commodity bull market, playing it hard and strong. I'm going to call it the big long, is what we're doing here in the commodity sector. So I'm going to dive in here, give you my financial opinions, and we're going to get going right here. Again, if you want to follow me at Finding_Finance, and if you want to join our community, finding-value.com. I do a midweek update, and I do question and answer sessions on the weekend to give you guys the most amount of opportunity to ask questions and to see what companies I like at that time. Rice soars to highest since 2008 on rising threats to supply. Rice prices soared to the highest in almost 15 years in Asia on mounting concerns over global supplies as dry weather threatens production in Thailand and after top shipper India banned some exports. So this is rice. Thailand urges farmers to curb plantings to save water. There it is. 2021, $400 a ton. We're passing about the $650 mark per ton. The rice is accelerating. Is this going to be inflationary? You should be shaking your head yes. I'm seeing elevated prices across the agricultural commodities, and we've seen it in food prices. Anyone who shops, I'm just amazed at how much stuff costs right now. And along with just everything. My dad made a comment. He's like, $10,000 back in the day was a lot of money, and now kind of feels like it's not much anymore. And I would agree with them. I mean, even $1,000, back in the 80s and 90s, that was a lot of money. Today, I mean, you can go through $1,000. If you go to the grocery store and kind of load up, you could be $300, $400, $500 depending on how much you purchased. And it's like, wow, this is going through the bank account quite quickly. But rice, yeah, soaring. Cuppy says, where are all my deflation bros? So off the recent lows, orange juice 45%, nat gas 43%, sugar 41%, gas 33%, uranium 28%, oil 24%, lean hogs 22%. This is inflation is good. It's kicking into gear, guys. And those are some pretty dramatic moves off the recent lows. They are moving. We kind of knew this. We did some charting over the past months or whatever. I said, you know what? This is what it could be. And it is coming to fruition in some of these commodities. And I think this is wave 3. If this is wave 3, I don't even want to know what my grocery bills are going to look like at the end of this. I really don't want to know. But my account values should hopefully do very well, and hopefully my dividends will definitely supplement whatever problems I have with my grocery bills. I am raising a family, and it's just the money that I make in the family. My wife works like part-time, barely. So we do have some pretty big bills, and I'm sure having the twin boys, they're 5 right now. They're not eating, like the teenagers are going to eat, but yeah, when they're teenagers, this is going to be interesting. Tavi says, after 9 months of underperformance, energy stocks are once again starting to outpace the overall market. From a historical standpoint, this trend remains at its early stages, with the valuation of oil and gas businesses currently at one of the most attractive levels in the last 30 years. The growth to value rotation appears to be resurging at full steam, coinciding with inflation rates potentially in the process of bottoming. So what he's got here is an energy to stock ratio. So it's energy to the S&P 500. This is a double bottom. And we've also seen these types of setups in other ratio charts. And I think that oil is going to do some incredible things here. I think that this little fractal we've got going on is somewhere in the range like of 2001, potentially. Maybe this pullback was the pullback that we saw is all we're going to get in the markets. Maybe. And then what's going to happen is that's where they overlap. The NASDAQ, S&P, and some of these commodities. Remember, they threw a whole bunch of SPR barrels at this thing. Then going forward, we could see, we'll say, sticky inflation and sticky interest rates. And that interest rate's going to weigh on the S&P 500. And I think energy is going to kind of just melt itself up as the S&P 500 goes sideways to lower. So that's kind of what I'm expecting. It doesn't mean that's what's going to come to fruition in the future, but that's kind of my best guess. Coming on down, we got, it's myself. It says, let me introduce the double bottom booty pattern. How about them apples? So we've got bottom one and bottom two. You've got the resistance or neckline, however you want to call it. So bottom breaks out, usually get a retest, and then you get some gigantic move to the upside. Well, we just so happen to have double bottoms in REMX and the ideal buy point. We've got COPX, the double bottom, ideal buy point up here. We've got lithium that's got the double bottom broken out, and it's starting to break its down falling wedge to the upside. So commodities, at least these sectors, have that double bottom pattern. They all look fantastic, guys. And the best thing that I could do is to basically buy it at these ideal locations and just hang on, just sit in them. I'm not a short-term trader. I know I do the daily technical analysis updates. I get it. People want that, and that's fine. But I like these stocks here. I would just throw a little bit in myself and just kind of ride it. And that's what I've done. That's what I've done, and that's what I'm doing. The big long. So this is the big long in oil and gas. So I'll go to this one first. It's an inverted shoulder, head, shoulder. You've got the neckline there. And then you've got the height and the projected move put on top of the neckline. Here's another one. A lot of the times I see this as a trend line that you're coming down and hitting. You create a head, you pop out of the trend line. You come back to create the right shoulder. You have a higher low. Then you break the neckline for a higher high. You're in a new uptrend here. And then the head size is your projected move potentially of that reversal pattern. The thing is, guys, like XOP, if you were to throw this on a logarithmic chart and you project the head to the neckline on top, it is massive. Absolutely massive. I don't know if they're going to go that high. Maybe they can. But that would also project that some of these companies could do some very ridiculous things. So, yeah, we'll see how far it goes. But yeah, I call that the big schlong. I mean long, just kidding. It says wealth building. It says the success to building wealth isn't about saving your way to success. It is about mastering a skill or solving a problem that society needs the most. That is truth. And the reason I wrote this and posted this is I see everywhere on Twitter how to save your way to success. A lot of the most successful companies, and I know I'm talking about companies here, they don't save their way to success. What they do is they fit and solve a problem in society, and then they grow the business to fulfill that want or need. And that's the ones that generally do very well. It's generally founders who founded the company, companies like Michael Dell or Elon Musk or whoever. And it's not these guys that are like chief financial officers that became CEO and they're trying to penny pinch absolutely everything. They usually don't do as well. I also put, I see this pattern everywhere. Anyone else see this pattern? I see it all throughout history. And what it is a big move higher. you get a double top, and then you come back down. This is the big leg of the downward move. You get one kind of hump, kind of humping over, and then you get one last lasting bottom pattern. SM Energy had this exact same pattern. A lot of the oil stocks, copper stocks, like all of them, as they come up and come down, even oil had it recently. That's this move here where you come down and come up, you come all the way down, come back up, and then you make your final last leg here, the little hump and the last leg. And this can be, it doesn't have to look exactly like this one here. It can be scrunched up. You can have this here and this one be higher, and it's kind of like working its way up, and then it comes all the way down. This here can also go sideways in a consolidation pattern. I just see that pattern over and over and over. And I just wanted to share it. It says each high and low being higher than the previous one. So it says central bankers always try to avoid their last big mistake. So every time there's a threat of contraction in the economy, they'll overstimulate the economy by printing too much money. The result will be a rising roller coaster of inflation, with each high and low being higher than the preceding one. That is what we are in. Get ready. It says, because most of them can't afford or can't qualify to get a mortgage to buy. Let's see how long this inventory problem lasts when there are no bids on what's listed out there. I know there's a lot of people that are very doubtful about the housing market, and they think that people can't afford homes. And I don't think average people are going to be able to afford homes. I think there's just going to be a gigantic rotation of money, and the markets can't accept that amount of money being rotated. And that's the problem. It's not about people affording the homes. It's where is the money going to go after it rotates? And I think housing and real estate is one of those areas that it's going to go into. It's not the only area. Commodities and hopefully precious metals are the other areas. All of this equity people have in their homes means nothing if there's no one to sell to and they can't realize the gain. That's the issue you have with 7% mortgages. No one can afford to buy what the homes are supposedly worth. Yeah, but I don't think that's necessarily the case. I would look at it differently. If you have a bunch of equity in the house, do you think people are going to just foreclose on the house if they can't make payments? No, they're going to make it work, guys. If you've got a bunch of equity tied up in the house that's worth $300,000, $400,000, $500,000, you're not just going to let that go away. You're going to continue to make the payments, and you're going to find ways to make those payments. If you're underwater and you owe $100,000 or $200,000 on a house, you're just going to walk away from the house. So what I think, if you don't have the sales up here, when people go no bid, I don't think people are going to walk away from the house either. There's no forced selling in this market. And all that equity people are going to hang on to. They're not just going to let it go. They're not going to be like, okay, bank, take my $400,000 or $500,000 in equity in the house. There's no way. That's my take. If home prices decrease by 5%, more than 200,000 households could be at risk of falling into negative equity, essentially going underwater on their home loans per core logic. So $200,000 household, or 200,000 households, that's not that many, even with a 5% decline. That is, I think, 1 month of supply. And that's going to get eaten up if those homes come out and if they're in good shape, they're going to get eaten up, in my opinion. So I don't think that's a lot of homes. Monetary demand for silver and platinum determines the price. Industrial demand determines how easily a change in monetary demand can affect price. So Nate was talking about, and this is what he says, does 8-to-1 ratio of silver to gold in the ground mean silver is going to go up? No, probably not until after you are dead. In this piece, I talk a lot about the supply-demand fundamentals of markets, what silver is out there, and what factors will be driving prices in the short, medium, and long term. I don't expect us to run out of silver for perhaps 120 years, and that might be too soon. Then there are caveats. It's not about running out. It's about supply and demand. And what happens is when that money rotates out of bonds, and bonds are seen as not a safe store of value, Where is the money going to rotate? The money cannot be absorbed in precious metals because precious metals are too small of markets to absorb trillions of dollars, like new trillions of dollars. The real estate market's big too, but it's still going to struggle to accept that amount of money. And if you get a rotation out of bonds and stocks at the same time, then you've got even more money that you need to absorb. So the monetary demand for silver and platinum determines the price, not what he's saying down here, in my opinion. It's money rotating, and the market conditions for that monetary demand will determine the price. And it's money that is flowing and shifting in the markets that causes asset prices to go up and to go down. It's money flows. Because I hear it argued that the inverted yield curve must not matter this time, because if it mattered, then it should have mattered by now. This misunderstands the 15-month lag. Now, we could get a slowdown. I know we've got the curve inverted, and there is a possibility that we can slow down, but everyone is calling for grandiose, gigantic crashes in the market. I don't think, if the housing market is tight and it remains tight, I don't think a slowdown in the market is going to crash the market and be some grandiose deleveraging event. I just don't think it's going to be like that. We could get a slowdown. We could get a recession where things contract a little bit, but it might not be it might be in real terms, but not nominal terms. It might be hidden by inflation. And that is where I think people are going to miss the opportunity. And then we could still see oil and all these commodities go up in the face of things slowing down in the real economy. Inflation could hide it. And that is what I think might be the case. And again, I don't know the exact future. No one does. But I don't know. I just think that people are too black and white. I think we're going to be living in the gray for a while. What does that mean? They think crash is black and white is a big bull, big, huge bull market and everything. I think what's going to happen is we're going to get a whole bunch of gray. And what that means is some sectors will do incredibly well in commodities. There'll be select sectors, maybe precious metals or something like that. And other sectors like the overall market and technology and stuff like that may not do as well. And there may be healthcare stocks might even do well. Because healthcare and some of these staples, like perhaps food companies or something like that. SRS Rock Report says Endeavor Silver, the all-in sustaining cost now at $22.15. And that isn't all the costs. Endeavor barely broke even with an adjusted income of $2.1 million based on 24.27 silver price. Endeavor Silver now losing money at the current silver price. Now, I know people are going to read this and they're going to say, crap, Endeavor Silver is a bad investment. Well, I'm going to look at this from a couple of different perspectives. One is, this is telling me that the physical silver price is a smoking deal. It is a smoking deal at anything in the low $20 per ounce price. We're not going back to low teens probably ever again if the all-in sustaining costs are this high and increasing. And then if that is the case, silver at some point will have to go higher in order to turn more mines on. Now, if that is the case, these guys that are we'll call it the break-even cost producers like Endeavor Silver, they are going to fly if silver were to hit the gas here. Because if they're not making any money, and then they make a bunch of money if silver were to go to $50 an ounce, that is, let's just call it a 25-ounce profit gain if their break-even is roughly $25 an ounce. That is $25 over something that they're not making any money today. So 25 over 0 is infinity. That is their margins that increase. So their margins and their earnings increase at an exponential clip if you're not making any money today and then you make money in the future. That's how we're going to get all these big gains in a lot of these mining companies. So I'm watching a lot of these companies. I'm watching the price of silver. And I'm accumulating the physical metals at these prices because you're under the cost curves, guys. This is like a layup. Now is the time, if you see a price in the low 20s, get aggressive if you know that it's below the cost curves of these mining companies. And guys, you know what's even crazier? These are mining companies that already have infrastructure in place. Do you know how expensive it's going to be to create new mines with new infrastructure? Oh my God. It's going to be expensive as all get out. So I am going to pile in to the physical and not really worry about it and just be patient and wait. And I know people get scared because the price goes down and they own it. I don't get scared, guys. I just buy it. It's a way to accumulate and preserve wealth. And if the inflation, remember, the cost of the commodity is determined by supply and demand and also your cost curves. And the same thing can go and apply to the real estate market. If your new homes cost a lot to build, well, no new homes are going to come to market if people can't afford them. And if people can afford them, then you'll get new homes at certain price points, and that's your new supply cost. Your new supply cost could be $25 now. And where's the price of silver? Sounds like an opportunity. That's what I'll say. Nat gas firming up. I wrote this. It was looking really good here, and we launched. We launched today. So yeah, it was perfect. August 8th, and now it's August 9th. You guys are viewing this August 10th. There's that same pattern I talk about, the double top, and then you get that big kind of come down, pull up, and then the big third leg with the hump. There's your hump, and then now we're coming back up. So I think nat gas looks excellent. We've got oil ETF, XOP putting in an inverted head and shoulders, PSCE as well. Again, these inverted head and shoulders are coming up everywhere. If you put it on logarithmic and you do a price projection, it's off the chart, guys. Same with PSCE, which is the small cap energy ETF, which is a mixture of exploration, production, and energy service companies. And we're starting to break the neckline here. This is go time, guys. And if you want other companies that I'm looking at and watching that are small cap companies in energy service, that's where I'm sharing all that information, is the finding-value.com website. It says millionaires live off 30% of their income, and millionaires invest the rest. To become a millionaire, you must do what millionaires do. And I do invest a large chunk of my income. And I have income that I reinvest back into it, and it's a compounding effect. So what does compounding effect mean? I'll just say this, guys. In the beginning, it sucks. It sucks really bad because it doesn't look like you have a lot of momentum that's working for you. So you're putting in tens of dollars or hundreds of dollars, and you're only getting tens of dollars back. As you keep saving, and as you keep putting 30% or whatever percent of your income into investments, it compounds. And then your investments start making a lot more money, and then it starts growing very fast. You're trying to maximize the difference between your income and expenses, and then you want to invest the rest. And when that starts to compound, you'll start making tens of thousands. Then hopefully it turns into hundreds of thousands and then millions of dollars a year. And that compounding can go pretty quick. So we've got Grady here. He says, been posting for years that BRICS will take over from the West. Many are now catching on, and many charts now mirror this development. For example, emerging markets chart. After a 15-year consolidation, it looks ready. We're real cheap here, guys. I think Grady's pretty much got his finger on the pulse. I think emerging markets looks absolutely excellent, and hopefully we can get a big move here. There's another one, EWZ, which is also the Brazilian market that also is exhibiting the same type of chart pattern as this. And we're also seeing it in Canada. It's the confluence of events that makes the evidence stronger for this gigantic bull market to come, and that we are very, very early in this process of the bull market. The best thing that you can do is not look at this stuff from a minute to minute, hour to hour, day to day. You want to look at it from big, long-term, big picture views like Grady is here. You want to look at it from decades and you want to take a position in this for a decade plus. And when you load up, I know a lot of people, they look at the short term, they're like, oh my God, this thing's going down. Oh my God, it's going up. What should I do? Should I sell out? Should I try to, guys, time out, man. Like, it's not about timing the short term. This is about accumulating assets to build wealth, generational wealth for your family for the next decade plus. And it's about protecting your wealth, growing your wealth. It's not about, am I going to make money this quarter? Guys, I just don't view it as such. And I know a lot of the traders view it like that. I'm not a trader. I'm a guy who wants to protect his wealth, grow his wealth, and get the heck out of the system. I don't care about 30% gains. I want 5 baggers, 10 baggers, 20 baggers in my portfolio. Now, to set this all up, you're going to have to ask yourself, how much risk do I want to take? And is it worth going after a 20, 30, 40 baggers? Some people will say yes. And then they see the losses or the volatility and they're like, I don't want to be a part of this anymore. It's whatever you can tolerate from an emotional standpoint and whatever is the best risk reward and the highest probability of success. Some of these ETFs like emerging markets or EWZ or some of these other individual companies that are large paying just ridiculous dividends can get you where you want to go over a longer time frame. I don't need to take all the risk in the world in a 401k if I'm 40 years old and I'm going to need it when I'm 75, 80 or 65 years old. I don't need to take on all the risk. I just want to compound that thing over a long period of time. So, just be careful on how much risk you take on because it may not pan out. And there's times where you can lower the risk and just start compounding this stuff. And a 5 bagger and 10 bagger is perfectly okay. And with the risk that you're taking, it may be the most beneficial of the group. And you may even have less volatility, which will be easier emotionally to hold on to. So, think about all that stuff. We're at the beginning of this big bull market, guys. I'm just going to tell you, don't blow it. Take advantage of it. Don't blow it. It says, if we gave everyone alive $1 million today, what percent of people would be broke in 5 years? My guess, 85% of the people. I'll just say this, guys. Money is going to go to the people that deserve it in the system. And whatever the system, the way it's designed, will go to wherever those people are good at doing something in that design system. So if you were to take money away from people or whatever, they're just going to make it bad. And then if you give people a bunch of money that are broke, they're going to be broke again. It's not there's a couple of things. It's what skills the people have developed, how smart or savvy they are in terms of saving and investing, and making these decisions day after day. So I think you're just going to end up with the world that you have today if you were to take money or give money to people. Eric Nuttall says, we believe that global oil inventories will end the year at multi-year lows, supporting $80 to $100 oil and allowing for debt targets to finally be reached, with companies then returning 50 to 100% of their free cash flow back to us via buybacks. Now, I don't think people understand that. Okay, so let me explain it real quick. If the oil price remains high at an elevated level, $80 to $100, let's say, these companies pay down their debts, which I think will probably be done pretty shortly with some of these companies, 2023, 2024. Then they're going to turn and buy back their stocks. So what does that mean? Well, if they believe that their stock is undervalued, they're going to buy back their shares, reducing the number of shares outstanding on the stock. So their market cap is going to remain the same, which is the way that you calculate the market cap is it's the share price times your outstanding shares. If you reduce the outstanding shares that are out there, what that means is that they're going to increase their earnings per share, driving the stock prices higher. Some companies have already started doing this, and it's going to accelerate going forward as the debt, they don't have to pay that debt back. So they're basically going to aim at buying back shares, reducing their share count, and increasing their earnings per share with share buybacks. Then what they're going to do is a lot of the companies are going to pay big dividends. So when they feel that their company is more fairly valued, they're going to give money back to shareholders. Now, how is a company that makes no cash flow going to do that? They're not. That's why these companies are so lucrative and such a great value. They may not be paying dividends today, but I think they're going to be future dividend payers at very high percentages. I really like the situation that we're in. It says what was once a forecast is now a reality. Global observable oil inventories are at an 8-month low, and we believe will end 2023 at an 8+ year low. We remain bullish. Grady says the historical mega-sized gold, silver, and platinum breakouts can happen at any time now. The charts are now ready for it for the first time since August 2020. This commodities bull is the opportunity of your lifetime. And at some point, commodities will be the only game in town. That hits pretty hard, guys. I agree with them. It says here's why Montney is likely the #1 natural gas play in Canada, US, maybe in the world. Tourmaline, they went on this Montney pad, drill complete on stream on Q4. The cost is $30.6 million. The payout of 3 months. Income to date greater than $130 million in cash flow. Forecasted internal rate of return is greater than 1,000%. There are a few companies in the Montney area that I talk about that are my favorite companies. You know one of them, guys, if you're a member, and you know that I am overweight in it. We were buying it when it was down. So hold on, guys. There can be some absolute ridiculous returns coming towards us in the future. You got to be patient. Ride this sucker. Don't get scared out. Don't worry about the volatility. Come to the question and answer sessions and ask questions. Ask me what I'm doing. I don't know everything, but I think I'm going to be close to riding this big boy from bottom to top. And we're going to be drilling like heck between it. There's a lot of energy service companies that I think will do very well. The goal, okay, so this is what we talked about last time. So I'm going to end it there, guys. That's what I've got for today. Thumb up for the content, subscribe to the channel, subscribe to the website. And we got a 5 p.m. Mountain Standard Time on Sunday for the question and answer session coming up, just as a reminder. And very, very positive, very excited for this bull market that's coming. Another thing I want to say is, guys, this isn't a sprint. We're not sprinting here. This isn't a 100-meter dash. You got to look at this as a long-term, pace yourself. Big long-term hold. This is where a lot of money is going to be made. A lot. And I think people, we might have to ride through a recession, a slowdown, and it may or may not impact our investments. But I can tell you, we need a lot more energy than what we've got. And if you can look past and look towards that, create that vision for yourself, looking out to the future, I think we're going to be rewarded hugely, hugely. And these companies are still of very great value. And it's a game against yourself now. Because when you get positioned, it's a game of emotional control, not get worried about the stock price movements. Focus on those cash flow generators. Focus on the ones that are going to be buying back shares, paying you in the future. And just hold on with iron grip. I think I said that right. No, what do they used to call paper hands or cabbage hands, however they call it. You don't want stuff just falling through your hands. You want to hold on to this stuff. Diamond hands. Diamond hands, guys. But that's what we've got for today. And we'll catch you guys later. This is Finding Value.